You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Well, hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Is infinite banking a scam? Well, I was looking up different types of phrases recently that people are Googling or trying to find the answer to. I just thought it would be helpful to record some podcasts answering some of the questions or popular phrases that people Google when they are trying to figure this out. And that was one of the phrases, is infinite banking a scam? Well, absolutely not. It's absolutely not a scam. But while I was looking into it further, I came across a very annoying Dave Ramsey episode. Man, that guy really gets under my skin. But he was going on about a caller. Somebody called in on his episode saying that a financial advisor had introduced him to infinite banking. And now I have no idea if this financial advisor had been well trained by a strong mentor, if he is a practitioner with the Nelson Nash Institute. I don't know anything about the advisor that advised this person who was calling into Dave Ramsey's show. I don't know if he had a good understanding or was teaching super well this client that he was trying to help. I didn't know if he had a solid, good grasp of the concept, but he was trying to teach or encourage this client of his to learn about or look into infinite banking to see if it would be a good fit for him. Well, right away, Dave just starts knocking this advisor, saying, oh, he's not a real financial advisor. Well, that's ridiculous, because how in the world could Dave Ramsey know if he was a financial advisor, his licensing and all of that? He's just shouting out, oh, he's not a real financial advisor. How could he have any idea whatsoever? He doesn't know who this person is talking about. So then he starts getting all riled up, saying that this advisor is selling a dividend. The way that the client mentioned it on the call, he mentioned that the advisor had said that there's a dividend and the dividend is really great with the policy. And so Dave jumps in and starts saying, oh my gosh, he's selling a dividend. How terrible. And he just couldn't believe it. You know, before I even go on about him and his thoughts about the dividend, I would just like to interject that Dave Ramsey is not a licensed agent. He is not licensed in the insurance industry or to be a financial advisor. From what I can tell in his past, he was never licensed at any point in time. So I love how he just dishes out the advice that he's not even licensed to give in an industry that is highly regulated. So much regulation, it's not even funny. Dave Ramsey instead is just a radio personality. So he's just talking on the radio, talking about things he's not licensed to talk about very confidently, as though he knows all the answers in the world. Okay, well, he doesn't. Okay, so back to him getting riled up about the whole life dividends. He's saying that the only way a policyholder would be able to receive a dividend is if first the policyholder overpaid for his insurance. And so maybe he first got his feelings or his thoughts on this from the IRS, who states that dividends from a mutual company are not dividends in the true sense of the word dividend, but that instead they are a refund of a deliberate overcharge. And actually, yes, the IRS does see these dividends as a refund of excess premium, and they can be accessed tax-free because of this. However, if you decide to receive your dividend payment direct to your checking account, those dividends only remain tax-free up until you've reached your cost basis. This means that the amount that you've paid into the policy. So if you pull out those dividends up into the cost basis, they will be tax-free. However, any money taken from the policy over and above your cost basis, including dividends, will be taxable. And to clarify, I'm referring to money withdrawn from the policy rather than borrowing against your policy. So if you just take a straight withdrawal, you just want to take your funds out, that's what I'm talking about. Because if you borrow against the funds in your policy, well, that's not taxable at all. So just withdrawals is all that I'm talking about. Dave goes on to say that the insurance company is simply overcharging you to be able to pay a dividend to make you feel like you're making money. Really, I mean, he really should know a lot more about something before he goes spouting off nonsense, is what I think. Okay, so I'm looking at an illustration right now of a client age 40 who started at a premium of $35,000 a year. That's base premium and paid up additions premium combined. So at some point, that paid up additions will have to come off. Then you don't have to start as high as $35,000. It can be almost any number you want. I just want to state that again, because just because this is an example of a higher number doesn't mean that that you have to have a high premium to start. It can be almost any amount depending on your age and your health and all of that. So this example I'm talking about is a person who started at age 40 at $35,000 a year total. And by age 70, he will have paid in this example, about $501,000 and is projected at that point, at that age 70, to have nearly $1 million in cash value. So I paid in about $500,000 and I can access just about $1 million. But I thought I was just simply being overcharged. And oh, by the way, the death benefit at that time is over $1.6 million and growing. I have another illustration here that at age 75 is showing $3.5 million paid into the contract and a projected $6.9 million in cash value. Now, I have to say projected because the dividends can fluctuate. And sometimes it's possible for a life insurance company to miss a dividend altogether. Although the companies that we work with have never missed a dividend since inception of the company, but it is possible. Certainly our world is a little nuts. And so it is possible for a company to miss a dividend, or it could be different than what they have projected. But the illustration and the company that I'm referring to at this moment is a very conservative company and illustrates conservative dividends. And actually, it's more likely that you would receive a higher dividend than illustrated. My clients who have had policies with this company and myself for over 10 years, we do find that the cash value is very, very close to what it was stated in the illustration years ago. Because one thing that's guaranteed about illustrations is that they are guaranteed not to look like that to your whole future with the policy. It's basically a guarantee to look different, because you don't know what the dividend's going to be. And so it's not going to be looking just like what you are looking at on the illustration. But anyhow, this example, $3.5 million was paid in, $6.9 million available at age 75. And that was with a death benefit of over $10 million by that point. So let me tell you, if I'm funding $3.5 million into a contract that ends up at just about $7 million when I'm in my 70s, that this whole time has been guaranteed to grow, protected from a bad day in the market, accessible income tax free, where I can access the death benefit for a critical, chronic, or terminal illness, and will ultimately leave an awesome tax-free legacy to my loved ones, I will take that deal all day long, my friend, all day long. I don't care what the IRS calls it. And if they call it something that benefits me, terrific, I will take it. But then the caller who's on Dave Ramsey's show then mentions how he didn't like how he would have to pay interest to borrow the money. And our friend Dave goes on to say, yeah, and whose money are you borrowing? You're being charged to borrow your own money. Wrong again, Dave. You're borrowing the insurance company's money. You're borrowing the insurance company's money so that your money can continue to grow. How awesome to be able to spend $100,000 from your whole life policy while it continues to grow and compound with guaranteed interest and dividends the rest of your life. So you're able to borrow money, use the value of the money that's in there. It will continue to grow for you, but you can still do whatever you had planned to do with that money while it's still growing. And how awesome to be able to access that money at rates as low as 4%, guaranteed for the rest of your life. Obviously, right now, interest rates for loans are much higher than they have been. And so lots of my clients have been very excited to know that they have access to money at 4%. I've had clients call in and say, oh my gosh, my car broke down, I need a car. And they can borrow that money from themselves at a much lower rate. And in addition, be in full control of that loan. They can charge themselves whatever they want. They can pay back whatever car payment they want to themselves. Of course, structuring something where you're paying yourself as an honest banker will be the best way and will be the best to grow their system and make it the best it can be. You will end up earning way more over time on that cash value that grows with uninterrupted compounding interest than you'll pay in interest on that loan. In addition, these funds are going to be protecting your family this whole time. And again, you're in complete control of the loan. Not to mention the awesome features of this strategy. I have not even incorporated the power of the actions of doing what bankers do with regards to your banking system. That is paying yourself back with interest. Just treating yourself like a banker and banking with this system, that blows it up to a whole new level. I'm just talking about the simplicity of the policy, how it works, and how awesome it is, even without incorporating the acting like a banker and banking with this policy and a system of policies. So then Dave goes on to say that your family doesn't get your cash value plus your death benefit. He says you only get the face value when you pass away. Well, it's true you don't get both the cash value and the death benefit if you're looking into the future at a certain time. However, you do get more money than what you started with. So if I use that same example of the person who was age 40, starting at $35,000 in premium, that starting death benefit was $890,000. By age 90, the cash value is projected to be at $2.1 million. And the death benefit is projected to be over $2.5 million. So if the person passed away, they're not going to get $2.1 million plus $2.5 million. They're just going to get the $2.5 million. However, that's much greater than what you started with at $890,000. In fact, $890,000 plus the $2.1 million is higher than the ultimate death benefit that will be given, but not that much. So you're almost getting your starting death benefit plus your cash value. It's just a little bit shy of that. People sometimes get hung up on that. Well, there's policies where I can get the death benefit and the cash value. Or why don't I get my cash value? The company's keeping it from me. Well, if you've built up $2.1 million, and that essentially would be what you would leave your family, and in any other kind of vehicle, isn't it nice that you can trade the company $2.1 million for a death benefit of $2.5 instead? Had you built this up in the market or anywhere else, this $2.1 million, you would have to pay tax on that. Your family would not get a death benefit that's tax-free. They instead would get that money minus any taxes owed. Whereas if we talk about those policies that do state you can get both the cash value and the death benefit when you pass away, if you actually keep that feature on the policy into old age, with that type of policy, it's way more likely to lapse. You're most likely your family's not going to get the death benefit or the cash value, because even these style policies that state, oh yeah, you can have the cash value plus the death benefit. These policies, if you have a good advisor, a good life insurance agent, would normally switch that over from cash value plus death benefit to death benefit only by the time that you are getting into your older years, usually over age 65 or so. So you might have had a starting death benefit. In this example, you might have had a starting death benefit of $890,000. And over time, it might be the cash value might be $1 million or $1.5 million or whatever. So yeah, if you passed away in your younger years and you had built up to $1 million or whatever before you passed away, you would be able to get the $1 million plus the $890,000 if your policy was still built in that way and did not switch over, if your agent did not switch it over. However, once you're in your older years, maybe age 70, 75, if you have a good agent advisor who's looking out for you and wants your policy not to lapse and doing the best they can for that, most likely your death benefit's going to bounce back down to that $890,000. It's not going to be higher than that. You're not going to get both, and you're going to have something like the same starting death benefit that you began with. Might be a little bit higher, but usually right about the same. And with a high possibility, these policies lapsing in general, your family is more likely to get nothing if you die at an older age. Wow, Dave Ramsey just really lights me up. This was totally not intended to be an episode about Dave Ramsey's nonsense. It just ended up being that way after I came across Dave Ramsey and his thoughts on IBC being a scam. So to sum it all up, no, the infinite banking concept is not a scam. I wouldn't have 9 whole life policies if it were. And I have been a financial advisor for just about 20 years now. And I wouldn't be putting all this effort into podcasting and teaching people this strategy for all these years if it didn't work and wasn't amazing. And I wouldn't be doing it for myself, obviously. It certainly would be much easier for me to just follow along with the masses and teach the same old thing everybody's teaching in the financial advising world with investments and mutual funds and all those things, your risk tolerance, investing according to this and that. Yeah, that'd be way easier because everybody's doing it and everybody gets it and everybody thinks that that's the way to do things. The thing is that I have to be able to sleep at night. And so I always will share the absolute best ideas and solutions that I can come up with that are in my clients' best interest and to help them reach their goals. I will certainly be answering to the big man upstairs someday, and I want him to be able to tell me, "Well done, my good and faithful servant." Anyhow, I'll stop ranting myself now and say that, as always, if you feel I would be a good fit for you and can help you, if you feel like you'd like to work together and have me as your IBC coach, please reach out to me at valerie@alphaomegawealth.com. I hope this was helpful. I hope it was interesting. I hope you have a wonderful week. Thank you for listening.
This is thepodcastfactory.com.